robust services exports and healthy inward remittance receipts would, however, keep India's current account deficit for the current year moderate and sustainable. Moreover, India's proactive efforts in pursuing bilateral and regional trade agreements with major trading partners are expected to boost international trade and investment, diversify trading partners, and integrate India into global value chains. Even on the external financing side, gross FDI to India increased at a robust pace during April to November 2025, for which we have data till now. Net FDI too increased as repatriations declined despite a rise in outward FDI. India continues to remain an attractive FDI destination for greenfield projects, as evidenced by a number of announcements made in this regard. However, FPI recorded net outflows of 5.8 billion US dollars till February 3 this year. As on 30th January 2026, India's foreign exchange reserves stood at a very healthy 723.8 billion US dollars, providing a merchandise import cover of more than 11 months. Overall, India's external sector remains resilient. We are very confident of meeting our external financing requirements comfortably. Now I'll be speaking about the liquidity and the financial market conditions. System liquidity, as measured by the net position under the LAF, which is the Liquidity Adjustment Facility, stood at a surplus of 70,000 crore on a daily average basis since the last MPC meeting in December 2025. There has, however, been an uptick, I may mention, in February, and now it is almost 2 lakh crore rupees. The Reserve Bank undertook several measures to provide durable liquidity in December and January. Based on assessment of systemic liquidity and its outlook, we announced and undertook further durable liquidity augmenting measures in the second half of January and February 2026. In response to the cumulative 125 basis points cut in the policy repo rate, the weighted average lending rate of scheduled commercial banks has declined over this period till December, for which we have data till now, by about 105 basis points. I may mention that the interest rate effect is 94 basis points. Similarly, the weighted average domestic term deposit rate on an average on fresh deposits declined by 95 basis points. This decrease on an outstanding deposit basis is 41 basis points over the same period. Coming to money markets, especially for CPs and CDs, that is commercial papers and certificates of deposits, the rates tightened in January 2026 after softening till December as a result of moderation, as a result of various factors, including moderation in surplus liquidity, excess supply from bunching of redemptions in CPs and CDs in January, and then there is always the year-end effect in the last quarter of the year. G-Sec yields mirroring global trend